Hey everyone, this is episode 46 of LongShorts, our weekly podcast, where we like to discuss everything relevant from the world of business and finance, but often other stuff that we find intriguing and interesting. And this season has been very interesting, I must say. We have had the benefit of having conversations with people outside the scope of myself and Sharad. We've been meeting a huge line of guests. And Sharad, how has it been so far for you?
It's been great. We've had a very diverse skill set in terms of the kind of guests that have showed up. So that's obviously been very encouraging and interesting.
Yeah.
There have been areas where I absolutely had no idea about and ones where I passionately follow. So it's been pretty interesting. And every episode, I think, has been very different and unique.
That's true. So last week was Stashman. We had Parikshit with us. Fintech, we spoke about credit, we spoke about, the role that fintech is playing in the world of online lending. We spoke about NBFCs. I think prior to that, we had guests from the world of experiential marketing.
Yeah.
People from the legal profession. Yeah, it's been quite a ride. But this week is just both of us, man.
Yeah. Back a little bit of revisiting the old school.
Yeah, I've been missing that also.
Yeah.
To be fair, I mean, I think it's a good way to chat.
Because we don't do enough of that.
Yeah, I mean, on a day-to-day basis, I think we are all kind of doing our own thing. So the podcast gives us a nice artificial framework to have conversations. Before we go any further, obviously do check us out on Audio Boom, on Spotify, Apple Podcasts, Google Podcasts, Stitcher, Deezer. We're also on something known as iHeart, which is a podcast app. So if you have that, do search for LongShorts.
I had that actually, iHeart Radio, way back in Canada.
Yeah. So we are on that also. So do search for us and hit subscribe so that you get that nice notification. And you can also check out our channel on transpin.in and scroll down, bottom navigation, click podcasts, and you'll find a page where you'll find all the necessary information on LongShorts. And we're also now cracking on with a podcast mailing list. So for all the old school guys and girls who like email, you can shortly start entering your email addresses so you get that personalized notification in your inbox whenever an episode goes live. So yeah, these were a few of the, I would say, house cleaning updates. I don't know what the word is, but let's get on to it. Today's agenda, I thought, we'll just set it before we start the conversation. So we
cannot not start talking about without talking about the economy.
Yes.
Right?
Yeah, it's been long due.
Sort of a flagship.
It's been long due as well. A lot of events have transpired over season 3, and we obviously could not spend quality conversation on it. Federal rates have gone down. Rates have gone down in India. Auto sales are down. There is like a wider...
Doves are in, man.
Doves are in. There's a wider concern around macroeconomic slowdown, consumption slowdown. These are the words that we hear on a daily basis. So we'll talk a bit about that.
Yeah.
Then we'll talk about our favorite listed
startup
unicorn of the country, Reliance Industries. They had a fairly active start of the week.
Yeah.
They had the AGM where they announced the deal with
startups generally have AGMs.
Yes, they do. This one does.
This one
does. And they did the Saudi Aramco deal. They announced that, and plenty of interesting things going on with Jio, Giga Fiber. They also announced some strategic partnership with Microsoft. So plenty of things to cover there. And thirdly, from content, commerce, and what is the third word? I forgot. For Reliance they say, right? Content, commerce, and one more. I don't know. It's like it's the pipeline.
Cash.
It's the pipeline metaphor that they hold the pipes, they push the content, and they also sell stuff. Anyways,
okay.
So from the content end, we'll kind of pivot to Viacom-CBS.
Yeah, yet another media merger, right? I mean, that's been the flavor on Wall Street for the last couple of years. But sounds interesting.
So let's hit it out. So macroeconomic situation. Today in the morning only I read auto sales declined by almost 19%. Dealerships are closing. I don't know, like 25,000-30,000 people have been laid off. And obviously it's being linked to the wider consumption slowdown within India. What are your thoughts on that? What do you think is going on? Are we going through a demand side slowdown finally? I mean, I think we were going through a supply side slowdown for quite some time.
I think so. Intuitively, yes. I think we are going through a demand side slowdown. the exact impact of sort of NBFCs or the shadow banking sector in terms of the auto loans. I don't know how to adjust for that. Let's say there is some of that in there as well.
Yeah.
Rate cuts have been happening. I mean, I don't know, was it the 6th or 7th consecutive rate cut that we did, right? With the RBI did. And I don't know how much of it is flowing through to the consumer. I don't know. But I think, yes, there is a little bit of demand fatigue. How, why? Let's discuss that. And what are your thoughts, though?
I think if you look at Indian auto sector, it's a great story, right?
Yeah.
I mean, 15, 20 years back, it was barely existing. And now you have Indian auto companies which are dominating the global scene, you know, speaking of players like Mahindra and whatnot. And I think that's why people are very emotionally invested in the sector as a whole. It's a great job generator.
Yeah.
It has put Indian industry on the global map. And obviously when the sector gets distressed, there's a lot of anguish which kind of spreads throughout the narrative. But that being said, I think Indian auto is pretty complex in the terms of what are the drivers behind its slowdown. Access to credit, as you said, that's definitely a role. I mean, NBFCs have been responsible for financing almost 60% of all commercial vehicle sales.
Oh, is that so?
Yeah, and 30% of passenger vehicle sales. And in two-wheelers, it's even higher. So, I mean, no wonder there's a liquidity crunch within the NBFC space that is causing lack of new business origination. Second is, there is generally a demand drop. Right?
Yeah.
I mean, that's kind of kicking in. Third is, I think, which is pretty much a wider driver, not just relevant to India, is just automation. You know, more and more automation is happening, and as a result of that, I think you just need less number of people within a factory unit.
Sure. Yeah.
From a productivity standpoint.
Yeah.
So I guess that also must be having. I mean, you can say that should not affect dealers, but I guess dealers are being affected by the demand, and automation is affecting the
overall
supply side of things, right? And we can obviously argue about high GST, and that kind of just adds as an additional burden.
Yeah.
But another very interesting driver in my mind would be the policy environment, right? There's a push towards EV, and I think all auto players are, I won't say struggling, but they're at least anxious because of that, right? I mean, they have to kind of plan their capex for the next 5 to 10 years, and they just feel that the regulatory environment is not there yet.
Yeah.
For them to commit so much capital to this domain, so that also probably causes a lot of stress. So yeah, I mean, when I see auto sales are down, I think consumption demand slowdown is a big driver.
Yeah.
But that's not the entire story, right? There are other things also going on.
Yeah. And what about other sectors, though? I mean, auto sector is not the only one that's sort of down. There are other big boy sectors. FMCG is down as well.
Yeah.
Overall spending is down, right?
Yeah.
So, I mean, I don't know. I mean, again, you can talk about the same narrative there, right? There's a little bit of a demand fatigue. There is less spending appetite, which is flowing through in all discretionary spending, I guess, right?
That's true. And it kind of trickles down from the global narrative as well, right?
Yeah.
If you look at the Federal Reserve, right? It cut the range to 2.25%, right? I mean, it's the first rate cut, I guess, in a decade now. And in case of the Indian context also, we have now seen a 35 basis point rate cut.
Which was, I found it interesting because I've never heard of a 35, like it's either like a quarter or half.
Yeah.
So that was interesting. But yeah, I mean, we're at 5.4 now, yeah.
I think out of 5 members in the MPC, 2 had voted for 25 only.
Okay.
And the rest of them, I think, voted for 35. I think it's just trying to achieve some sort of a middle ground.
So maybe take a weighted average then.
Yeah, might have been some exercise like that.
Yeah.
But the fact that typically, I mean, when rate cuts happen in the US, there's usually a story for capital flow to come in.
Sure.
India,
Yeah.
right?
Yeah.
Or the developing world. But right now the story is that that means we also have some room to cut our rates.
Yeah. Race to the bottom.
Yeah. So this kind of is showing, right, that how the overall global narrative itself is becoming more and more bearish. I mean, I was reading like Goldman Sachs, Merrill Lynch, they also came up with notes in which, they were kind of putting, there's a 1 in 3 chance of a recession in the next 12 months, GS reduced forecast for the US.
Yeah.
There is, that entire US-China trade war issue, which is kind of, popping in and out. So I guess overall, the macro condition is stressed.
Yeah.
But I do feel that the stress is, because, I mean, let's face it, the trade war also affects manufacturing sector.
Sure.
So the stress is primarily showing there. I mean, even in the Indian context, like why just auto and FMCG, even I think Tata Steel, they announced that they have reduced their capex from like 12,000 crore to 8,000 crore.
Yeah, that's significant, right?
So this shows, right? I mean, Tata Steel is one of the major, steel demand is coming from infrastructure, it's coming from roads, it's coming from auto itself, right?
Yeah.
So I guess that's dropping there. That's why their capex is also dropping down, right? So that correlation can be thought of in that manner. But I wonder if it's outside manufacturing. I mean, maybe services is still insulated, right? I mean, if you look at within India, services is a much larger part of the economy, and services is actually where the indicators are slightly better than the other.
Yeah, we're talking about India.
In India,
yeah.
So it might be a case of that there is a global slowdown from the US-China trade,
which impacts us,
which impacts us, but it only impacts within the manufacturing block of things.
Okay, yeah.
Like for like, and because the consumption cycle also again impacts more of the manufacturing block of things, right? Yeah. I mean, services are just. I was reading this very interesting book. What would the great economists do? Mm-hmm. Have you heard of that?
No.
So it's a book where they.
I haven't even heard of a great economist. No, I'm kidding.
Yeah. So these are here they're talking about the real greats. Let me just Google it, and so it's Linda Uy.
Okay.
I don't want to sound ignorant, she has looked at 12 economists.
Okay.
Guys like Adam Smith.
Sure.
David
all
Ricardo,
that far back. Okay.
Karl Marx.
Yeah.
The big guys.
Okay.
And she has looked at modern issues and how these economists would view these modern issues.
That's such a difficult extrapolation, but yeah.
So I mean, I think what she's writing is it's basically a biography of 12 people.
Sure, yeah.
But she's using the modern context as a lens of looking at these 12 people. So for instance, in case of if you look at Adam Smith, like how would Adam Smith look at something like a Brexit, or that's the kind of extrapolation that
he wouldn't base the decision on a referendum, though.
Yeah. So I mean that's the conclusion that she was kind of bringing to, that at the end of the day, there is a big effort to quote unquote re-industrialize the Western world, right? That go back to manufacturing. But
sure.
Most of them don't realize that manufacturing is not going to drive things anymore. It's a services sector.
Yeah. And high tech.
Yeah. And it's exactly either it's advanced manufacturing or high end services, right? Which is going to drive the world. And in India, we have just leapfrogged straight from agriculture to services.
Yeah.
So I mean, I'm still optimistic that maybe, I was reading that the biggest 5 IT companies in India, they are actually, their hiring went up by like 50% in Q1 this year. Mm-hmm. So this is happening in the background of all the other negative stories coming in. So probably that sector is perhaps a bit more insulated from the rest.
Yeah.
Right?
And when I look at the sort of overall economic or whatever I read, like there are a lot of counterintuitive things that pop up like all of a sudden, right? Like in the case of US, 3.7 unemployment rate, one of the lowest, and a rate cut. Like you would have generally expected something else, right? And then you can argue that inflation is sort of still behind, so there's room to cut rates. But what the textbook says and what the real world is behaving, there's so many areas where which make you think, I'm like, okay, that's not what the textbook says. Right. But there are these counterintuitive things that are happening, which is so difficult to build a causal link around because there's just so many variables.
And they are intertwined, right?
Exactly.
This kind of shows the extent of the role that is played by globalization. That, it might be a case that, you had corporate tax breaks in the US, so companies are, kind of not shy of hiring people. So domestic hiring is doing okay. Yeah. But the effect of, higher tariffs would also play a role. Yeah. And hence there was a requirement for a rate cut. I mean, it might be a story.
No, yes, right? And that's sort of how you build a causal model, right? Yeah. I mean, spending, and that's what the argument was against sort of protectionism anyway, right? Right. So, it's very interesting. And let's see how, I remember in the budget speech, our finance minister, Nirmala Sitaram, she'd said that what India needs is a significant rate cut. I think something like that she'd said, right? Yeah. And it so happened. I think it was very well documented.
Ever since the governor and RBI has changed, everything that the government says actually happens. Yeah, so sorry.
No surprises there.
Yeah. But that David Ricardo chapter, I just recall one thing. He was talking about, he was a British economist, and he came up with this theory of comparative advantage, which says that if you are more efficient at producing something versus the other, you should import the other thing and produce that first thing. So
and that's the fundamental principle of globalization, right?
Exactly. So he's like, everyone is better off if you do that.
Yeah.
Obviously, it's a simplified argument.
Sure, yeah.
Because, if you cannot produce something more efficiently today, that doesn't mean that you cannot produce it tomorrow.
Correct.
So as per his framework, you should just import it, and, protectionism should just be discounted for. So I'm not saying it's a perfect theory, but I think a lot of the, I would say, resistance or repulsion against globalization that we see in the 2019 world comes from that frustration.
Yeah.
That, this theory of comparative advantage is way too simplistic to think of things.
Yeah. No, yeah, maybe it is, right? And I remember, this is probably 2013, I remember reading, and this is pre-Trump, pre-anything, right? 2012 or 13 when Barack Obama was in power. And I remember reading an article in The Economist which says that the last couple of decades were all about globalization. The next few decades will be about internalization.
Yeah.
And so far the call seems fairly accurate.
Yeah.
That's what's happening.
Absolutely. Yeah. But thinking of comparative advantage, Reliance has done something very, very spot on in that entire paradigm, right? And I think Reliance and Saudi Aramco both have done something very spot on, right?
Yeah, they've got a VC investor.
So Reliance finally is a VC investor. The Vision Fund. This is the closest to the Vision Fund you can go to.
And they've diluted. Guess how much they dilute when a VC comes in? 20%?
Yeah, I think that's the number, right?
Yeah.
So, but yeah, I mean, you've obviously gone through the deal also at a high level, but I guess the bullet points are $15 billion investment from Aramco into RIL's oil and chemical business.
Yeah, I'm valuing it at $75 billion.
So Aramco produces the oil, RIL does the refining. Time to kind of match the comparative advantage, I guess, right? That's the angle here?
Yeah, I think that's exactly it, and sort of exploit synergies and use each other's comparative advantages to build a bigger beast. I mean,
plus payback debt they have taken for Jio.
Which is significant. Because you say that, I mean, that's the sense of it, right? I mean, one of the things that jumped out was he was saying that in the next 18 months, it will be a zero debt company.
Right.
Which is interesting, and I mean, also, like, I'm sure once they are zero debt, then bankers will keep knocking on their door that you have so much of debt capacity, why don't you lever and all. But yeah, that's sort of the flagship thing that jumps out, right? In 18 months, zero debt company. The other thing that really I found it interesting was for the next 5 years, each year expecting 15% EBITDA growth.
Right.
So which is healthy, right, for such a big
company. Talking about the energy business.
No, overall. Yeah, overall, and of which they say that Jio and retail will account for 50%.
Yeah.
So it's clear where sort of it's heading as the ship is going, right? It's more retail, more Jio, and sort of that is going to be the core. So it is a big ship to turn, and it is turning, and we can see it. Like, they're putting themselves on the line by making these claims. So it'll be interesting. I mean,
they get the benefit of a higher multiple. But,
sure.
They also get the funky perks of running a telecom and consumer style business, right?
Yeah.
It's a very different animal versus
anything else. Yeah, it is.
I mean, there it's something very tangible which is kind of going in, right? It's a cash cow.
Correct. Yeah.
This is much more, I would say, capex first and
see
how it goes later.
Yeah.
And I was reading that RIL has like almost 37 billion of net liabilities, out of which roughly 20 billion is telecom.
Okay.
So I guess out of that 15 billion is coming now from Aramco.
Yeah.
I mean, those are, I guess, going to be one of the uses of funds.
I mean, yes, that it will be. And listen,
But this will ease the Bernstein brokers, right? I remember Bernstein was writing those notes, right, where they were really getting concerned about RIL's
ability to
levering up.
Exactly, and ability, like, will it long-term sustainability when you invest so much, and sort of the financial aspect of it, right?
Right.
And that's the thing, right? I mean, there is a way, I guess, and it's I mean, this is what a lot of other telecom carriers were initially worried about as well, right?
Yeah.
Like, the undercutting, the price point is not in sync with the capex investments that you are doing, right? Yeah. But yeah, I mean, that's, I guess, benefits of being a conglomerate, I guess. I don't know.
No, I mean, it's a good. I think it can be it's a good kind of what was that? I was reading two birds with one stone. That was the headline that I was seeing. That you delever also, and you also kind of have operational synergies of tying up with a major oil producer. Yeah,
and the stock reacted, right? It was up. I think it was one of the biggest daily hike or uptick in stock price for years. I don't know how long, but I think it jumped significantly, right?
Was it because of this, or was it because of the mega set-top box.
It was all it was like so many things, right? I mean, mega set-top box as well. I mean, they're also eyeing content, which is no surprise at all. And the focus is on sort of creating some kind of partnership agreements and bundling Geo Fiber, which is what the fiber to the home kind of setup, which they want to release.
Which is something that you have been, I think, we have been discussing. For
Yeah,
some time,
like
right?
that is the long-term plan, sort of to get into every house and create an Internet of Things and have as many devices connect with you in it. And like our old joke, as we say, when you don't know what the product is, it is you. Ultimately, I think we will turn into becoming. But next is content. I mean, they've got fiber in the home. They've got free, like not free, but excellent low price LTE service, 4G networks.
Right.
So next is 5G and sort of take Internet of Things to the next level.
Right.
Obviously investing a lot in fiber. And the set-top box or whatever, the thing is they're sort of tying up with leading premium video streaming services as well.
Have they given any names?
They might have, but I haven't seen any. I probably missed it. But and the monthly plans are like range from like rupees $700 to rupees $10,000.
Oh, okay.
So you can see the wide range there, right? And one interesting thing was that in the speech and in the sort of in the announcement was that you will be able to see a few movies on the day they release at your home.
Okay, first day.
It's called day and date release, right? So, and it was funny, they said that, and then I think hours later Inox came with a press release saying that the distributors, the exhibitors and the producers, we all have an arrangement that in India we'll observe an 8-week theatrical window.
Right.
So there is a minimum 8-week theatrical window.
Right.
So they were sort of undermining that it's not going to happen because, I mean, the one thing that exhibitors around the world are scared of is this day and date release. Because, I mean, tech has become so good. Like, I mean, you're a purchaser of a brand new TV. You would know, like, the quality of TV and quality of sound these days are pretty good.
Yeah.
People are happy to watch a movie on their big giant screen, right? Yeah. The only competitive advantage exhibitors have had for the longest time has been time. That you can't watch it for weeks or months.
I mean,
right?
time, and now I guess that's why all this, IMAX, 3D, 4D, all those kind of things probably came also as a reaction to this, right? To kind of compel people to go to the theater, to actually have some sort of a differential experience. But because otherwise, there is not much of a difference now in terms of quality of the experience itself. And okay, so I guess that's the problem, right? I mean, now that India's biggest startup has announced it.
Yeah.
I mean,
and
it will happen.
It will happen. And they're saying, like, they've given dates also. Like, one of the things I read was that they'll have their IoT platform starting January 1st, 2020.
Okay.
Which is not too far at all. We're almost more than half the way.
IoT platform.
Yeah, which is like basically the 5G network of connecting everything.
Right.
And they're saying the annual revenue opportunity for Jio just by this is 20,000 crore. So, the claims are there, numbers are there, timelines are there. Right. So, I mean, in world of equity research and investment banking, when management gives you these numbers and this kind of guidance, you generally take it with a lot of positivity because otherwise CEOs and up senior management are not very comfortable giving so many data points. Because now this is what you'll be judged on. You don't hit 20,000, stock will suffer. I mean, Reliance is a different case because it has so many levels at play. But so I was actually pleasantly surprised by the granularity of guidance that was given. I have not seen it. It's not very easy. I mean, Netflix does it, but not a lot of people give such detailed things and share their forecast, internal forecasts. Right. Obviously, there's a buffer in there, I'm pretty sure, but still guiding to the market. So that's sort of what's happening, and obviously there's a lot of tech elements to it, which I'm not an expert to talk about. Perhaps you also know something. But what are your views on seems in good shape?
I mean, it's to be fair, the Aramco deal is something which I think was kind of very, very crafty piece of financial
and that was what jumped out,
right? And that I think jumped out for me also. In terms of Jio, obviously it's kind of, I mean, it's a bit blue sky. I won't say blue sky, but I mean, there are a lot of plans which have been announced. I mean, the entire idea of, I remember there was a time when, when the mobile revolution 1.0 started, people thought that, it's end of the fixed line, it's end of the landline, it's end of all those, I would say localized solutions. But with things like Geo, Giga Fiber, I mean, it seems that, no, not really. I mean, there's an entire, bouquet of offerings which can come from there and which can be monetized. Yeah. So
I think DTH operators like Airtel and Tata Sky, I think they'll sort of be wary of what's happening. They're sort of, I don't think the local cable operators are not, because they're going to tie up with this set-top box, a lot of that's how they'll operate. But the close competitors, DTH guys like Airtel and Tata Sky, jump out.
But now now these guys are going to go till last mile, right?
Yeah.
I guess that's the idea.
Yes, they will tap with the local cable operators.
They will still do that.
They will still do that. They've said that.
Right.
So local cable operators are fine.
So they're providing the backbone infra.
Yeah.
Right. But I mean then they'll also have the content.
That's the next thing, to sort of get into content and
because if you have tie-ups with the OTT platforms,
then
I guess the offering would have to be available at the retail level.
Correct. Yeah, and that's what. And another thing was which you alluded to right in the beginning. There was something Microsoft partnership with what?
I mean, it's a digital transformation alliance. Yeah. And actually they did not put a press release of the Geo Giga Fiber on their site.
Okay.
They only gave the press release to the Aramco deal and this alliance that they are doing with Microsoft. It seems, I mean, at a very superficial level, to be some sort of a partnership with regard to cloud solutions.
Yeah.
I guess there's more data localization requirement from the Indian regulator. So Microsoft would anyways probably have to tie up with some local player to expand its Microsoft Azure platform.
Yeah.
And Geo seems to be that player.
Yeah, that's interesting. They've got the hands in multiple different verticals, right? So that's always and some crafty financial engineering, as you say.
Yeah.
More in future, I guess.
Yeah. So I mean, they're obviously they're offering, they're claiming to offer that they will give a efficient and affordable cloud infrastructure to startups, to MSMEs. There's not much detail on it right now, so it's difficult to tell how it will shape out. But looking forward to seeing how it comes.
Yeah.
And in terms of content and in terms of media, it's such an interesting space.
Yeah.
You're obviously very passionate about it, and plenty of things going in the Western markets as well. Viacom and CBS.
Yeah.
Big bang merger, right?
Yeah. It's big. Like, I mean, CBS I think is about 19 billion, and Viacom is about 12 billion, so fairly big. They've tried this before. In fact, they were one earlier that sort of branched out. So it's and they're sort of, a lot of people have in the media landscape, as far as I'm concerned, and I highly encourage you to read this book, John Malone's Cable Cowboy.
Right.
And it's an excellent book, but what he also sort of says, has been saying this about a media roll-up play, that there is a play in the US ecosystem or the world media ecosystem that you just got to keep rolling up assets and you can create like a beast. And you're somewhat seeing these things happen. Like, I mean, the last couple of years, like we've seen Disney, Fox combine.
Yeah.
We've seen Comcast, NBC. We've seen AT&T, Time Warner, and Lionsgate and Stars. So you have seen a lot of M&A activity, and this is no different, right? Viacom is a big cable programmer. MTV, Nickelodeon, Comedy Central. These are the sort of things that they have. And CBS is a broadcast TV network and owns like Showtime.
Right.
Showtime, HBO, and Stars were like the top 3 paid premium channels in the US, and all of them have like Showtime focuses more on boxing and live sports kind of a thing. HBO obviously historically is focused more on drama series and original content, but there's a lot going on there. And listen, how it'll shape up, I don't know. It's clear that they want to bolster up their balance sheet.
Right.
It's clear as a combined entity, they can focus more on creating programs and programming partnerships. CBS, one of the flagship things it has rights to NFL.
Right.
Which I think get done in 2020, 2022 or 2020. I'll have to look that up. 2020 or 2022. I think 2022.
Right.
But Amazon is knocking on the door. Like the big boys, Apple, Netflix, Amazon, and Facebook and Google. You can't discount them anymore because they're also fighting for content. So these guys really
They have a lot of cash.
They have a lot of cash. So I mean, if Amazon Prime or Facebook, and Amazon already has some NFL games rights and some for some sets, some I think Friday night games or whatever.
Right.
So if these guys show up and say that what's tell me your price and I want NFL right, NFL will probably sell to the guy or to the firm or to the company which bids the highest, right? I mean, CBS probably assumes that relationships are deep but they need money, so they have to bolster it up, and let's see. I mean,
so you seem to like be hinting that it's more kind of a strategy play from Viacom-CBS perspective in order to ensure that the revenue pie keeps growing.
Yeah.
But what about the big OTT guys like Netflix? How do you think they must be reacting? I mean, the reason I'm saying is today only I got an email from Netflix that my subscription charges are now being revised. I mean, I still have the UK account.
Yeah.
Now they increased it to like £8.99.
Yeah.
£8.99.
Yeah.
So I mean, they're also kind of feeling the pressure now, right?
Yeah, I think so. I mean, Netflix feeling the pressure on 2 fronts, I guess. One is the pressure that they'll always have and they always will, which is to keep churning out good content, and content is not cheap. I mean, they're still not free cash flow positive, which is just, for me, it is the best way to look at a content company. is like they're not generating any free cash flow, right? Growth is stellar, top line, EBITDA revenue, but they're not. And that just is a testament to show how much you have to invest in content to keep the gap, to keep it running, right?
Yeah.
So obviously that's one pressure. The second pressure is that earlier they still piggybacked on Disney content or Marvel content or other content, not HBO because they're direct rivals, but now those guys are pulling themselves out. So it's a double whammy. Now they have to sort of get even better. They don't have the luxury of de-risking themselves, saying that Friends ran well, Office ran well, let me buy up the rights. No, because you don't know that anymore. They won't be there now. So gradually they, so that's a big thing. So I don't know how that, but in terms of subscribers, like Netflix has 150 million subscribers. Disney, which just launched a streaming service, right? I mean, it's not even been half a year. They're saying that they want to hit close to 90 million by 2024. That's an internal target. So significantly behind, right? AT&T owned HBO. They said they want to hit 50 million by 2024, same time. So Netflix has a subscriber massive head start, but what kind of content you keep providing them, that's a challenge. Like, what do you think about live sports on Netflix? That's like a question that no one has the answer to, and people have asked this to Reed Hastings and all. Like, would you, or other than drama or the kind of content, what would, as a user, does news or sports, anything would appeal to you to become Netflix even a more enticing product for you?
I mean, I just think, I get the product and distribution base that Netflix has. But like guys like Hotstar and Prime matched it very quickly. I mean, maybe not in terms of the quality of content. I mean, they're kind of positioning themselves for different audiences. But in terms of the actual sheer product play, I mean, the products look identical now. There's not much of a difference.
Agreed.
So I mean, I think, and most people who can afford, they look at these as bouquet of 2-3 services that they need to be on. I mean, I don't know whether there will be a time when I'll feel that, okay, Netflix is my single window solution for all my content needs.
But they're not sort of infinitely additive as well, right? Like you will, like Disney, you probably want Disney for something. You probably want HBO content via Hotstar, so you want Hotstar. You definitely want Netflix. You definitely want Amazon. Amazon is interesting because they have e-commerce angle, but that's what I wonder. Like I don't know the answer. Like when do you stop, right? I mean, let's look.
I mean, like right now, like for instance, I look at Hotstar more for local vernacular stuff. They just have more variety there. Right. You, I think, look at Hotstar for sports.
Yes.
Right. In case of Amazon Prime and in case of Netflix, it's primarily like you search for something on one. You don't find it. You search it on and you find it, right? And you play it there. So I'm sure if both of them, I mean, unless both of them or all three of them are targeting the exact same segment, right, then it's a different story. But they're also targeting different segments, right? So, I mean, it's a very difficult, the only cap here is that there are 24 hours in a day. I mean, so that's the only cap one has. Nothing more and nothing less. But, I mean, that being said, if suppose tomorrow Disney or, Viacom or a CBS comes up with an OTT platform, say in India, they'll have to do a lot of work to actually, first I would say get that base running, right? I mean, these guys are already, these guys are already generating so much content and they already have that kind of a distribution entrenchment within the audience base.
Disney though owns sort of Fox and Hotstar, so we'll see Disney content via Hotstar, so that'll be interesting. But I see a point. That's exactly what will happen if someone else comes up with another platform, because YouTube is also doing that, right? I mean, every time I watch something on YouTube now, I get that prompt: skip trial or sign up for premium version for 1 month free or something like that.
Right.
They're also trying to sell me that subscription.
But probably the reason why you might not is you already are paying something to these guys.
Exactly.
Right? So I mean, that way that it suddenly becomes a cap. I imagine YouTube has a wide variety of content in its own right. Right. But it's more UGC. So that's probably not the most tempting criteria. Here you get premium stuff.
I mean, they're moving to premium as well. There are shows now. But it's just so much content out there now.
Right.
And it's and people are trying to monetize every piece of it, right? I don't know how it goes.
I mean, I actually feel that, I mean, as a user, I feel that there's a saturation point.
Agreed.
Close by. I mean, already, like when we were reading about when Friends in Office got, withdrawn from Netflix, I think, right? I mean, then there was a lot of data that how they were actually responsible for, 50% or 60% of the eyeballs. And I just think people very quickly want someone to tell them what they should see. Like if there's too much choice, it's the same thing, right? You flick through 100 channels, right? After some time you just get tired. So I think we are already hitting that saturation point. Now it's a question maybe of how much people are ready to burn, from a platform perspective.
Yeah.
I mean, who burns the most, and the other person, I mean, then the other people like just kind of lose out and then, restructure and focus on something else. I really don't think that in terms of a product differentiation play, there's anything, which is very creative out there now.
Unless you access cheap credit. No, I'm just kidding.
Unless you access
cheap credit.
Yeah. So from the OTT perspective, I mean, I don't know how it kind of will pan out, but it's very fascinating to see guys doing different things.
Yeah.
And I think on that note, we can call it a day. And it's been amazing, Sharad. I mean, it's been both of us after so long.
Yeah, it's been fun.
I thoroughly enjoyed.
Yeah, and we spent a great deal on in a sector that I'm very passionate about, which is the media OTT. So that was fun.
Yeah, that's true. And with that, would like to obviously welcome all our listeners to subscribe and comment on this episode. Tell us what we can do better, and we'll try to make it work. With that, this is Nikhil Arora.
This is Sharad Tupran
signing off.